Hi, welcome to this financial insight session where we will unravel one of the most crucial metrics for evaluating a company's dividend sustainability, dividend cover. Whether you're a student preparing for exams or a finance professional navigating real-world scenarios, understanding dividend cover is essential. In this video, we'll break down what dividend cover means, how to calculate it, and what its implications are for both investors and businesses. Let's dive in as we look critically into this fantastic financial metric. Let me share my screen as is our custom. Let's look quickly into this ratio. Okay, dividend cover measures the number of times the ordinary share dividend for an accounting period could have been paid out the available profits for the company. So we're looking at the coverage of the dividend payout above the earnings per share. How many times does the dividend cover the earnings? This is very important. So it's calculated as the earnings per share divided by the dividends per share, where the earnings are the base used to pay dividends. So how many times do the earnings cover the dividends paid out? The dividend cover is a financial metric that measures how many times a company's earnings can cover its dividend payment to shareholders. It is essentially the inverse of the dividend payout ratio, and it's used to assess the sustainability of a company's dividend payment. So in the last video, we looked at the dividend payout ratio, where the dividend per share was the numerator and the earnings per share the denominator. Or in the dividend cover, we're looking at the earnings per share as the numerator and the dividend per share as the denominator. The dividend cover ratio, or a high one, indicates that the company has ample earnings to cover paying dividends, even in the face of profit fluctuation. So where there is a high dividend, as we're going to see in an example very shortly, or a low dividend, it all depends on the earnings of the company. So graphically, again, we have the earnings per share and the dividends per share. That's the formula, where the earnings per share is the portion of the company's profit allocated to each outstanding share of stock, and the dividend per share is the total dividends paid out divided by the number of shares, like we've calculated expressly in previous videos. Okay, so let's look at an example with Shareholders Nigeria PLC, where you have the bottom line earnings, which is our profit after tax. We've also looked at the deductions, where total dividends have been paid. We've calculated the dividends per share, the earnings per share, the dividend payout, where we deducted even the preference dividends applicable. So let's go to our solution sheet and calculate our dividend cover. So from the formula, we have it. Earnings per share, we pick our earnings per share, which is 13 kobo. We have the calculator just follow me closely. 13 kobo. And we pick our dividends per share, which is 28 kobo. We state as this. So our dividend is calculated as our earnings per share divided by our dividends per share, and we have it as 0.45. So 0.45 is 2 in 0.47, meaning our earnings is 45% of our dividend payout. So we paid our dividend less than what we earn. This must have been out of accumulated retained earnings or accumulated profit over the years. Possibly the company has a fixed term policy to pay dividend every year to make ordinary shareholders smile to the bank. So what does this mean? What does this mean? The dividend cover shows how many times a company's earnings can pay its dividend. The higher ratio indicates the company has more than enough profit to cover its dividend payments, signaling financial strength. Or in this case, we just said the earnings is about 45% of the dividend paid. So they must have augmented the remaining balance to pay off the dividend. Like I said, possibly from retained earnings. While conversely, a lower ratio might suggest the company's dividend is at risk of being unsustainable if earnings decrease. The implication is that a high dividend cover suggests that the company is in a strong financial position, can easily afford to pay dividend. So where the earnings cover is above 1, 2, 3 times, earnings are sufficient and significant enough to pay your dividend. Or in this situation where we have 0.45, not even up to 1, to pay out that amount of dividend shows additional buffer from somewhere is provided to sort out the dividend payment. So strong financial position provides where it's easy to pay dividends with plenty of earnings left for investment or buffer against future downturns. A low dividend cover implies that the company's earnings barely cover the dividend, like we saw in this situation, 0.45 to 1, which could be risky if profits decline, potentially leading to dividend cuts. The cause and effect is clear. Cost includes a high dividend cover, strong earnings, conservative dividend policy, prioritization of the investment over dividends. And the effect is also clear. It provides a safety margin for dividend payments, reassuring investors that the company can maintain or increase dividends over time. While a low dividend cover is caused by a high dividend payout policy, like we've seen in this example, 0.45 is the earnings to 1 dividend. So there must be a policy to ensure that even with low profitability, dividend must be paid, which is a graphic scenario or the graphic example we've just seen in this last example. So a high dividend payout policy on low profitability is the cause, while the effects, the risk of dividend cuts in case of a downturn in earnings, which can negatively impact investor confidence. These are the effects of a low dividend cover. So in conclusion, dividend cover is a key measure of the sustainability of companies' dividend payments. The high ratio suggests that the company is well positioned to continue paying dividends even in tough times, providing stability for investors. So where earnings were low and dividends were higher than earnings, this is like an assurance provided to shareholders, investors, that their returns are guaranteed. While a low ratio can be a warning sign, potential cuts in dividend payment if earnings fall. Investors typically prefer a dividend cover of at least 2. So in this last example, we saw it's 0.45, not even up to 50% of most 1. So a dividend cover at least 2 gives confidence to investors, meaning the company earns twice as much as it pays out in dividends. This is very, very critical. All right. Now that you've got a solid grasp on dividend cover, remember, whether you are studying for professional accounting exams or applying these concepts in the workplace, this metric is a vital tool for assessing the financial health of any company. Very, very important. Okay, if you found this video valuable, don't forget to like, share, and subscribe for more depth and insights into financial ratios. Until next time, keep mastering the numbers. See you in the next video. And until then, bye for now.